Welcome back to Talk Tickers. This is the deep dive, the place where we stop pretending that skimming headlines is, the same thing as doing the research.
Right. We take the earnings calls, the investor decks, and we basically strip mine them for the actual signal.
Exactly. We are here for the seriously curious investor who wants the bottom line without all the corporate fluff. Today, we're turning our attention to the Keystone State, Pennsylvania, but with a very strategic detour into New Jersey.
A very important detour.
We are breaking down Fulton Financial, ticker FULT. They just dropped their Q4 2025 results, and I have to say, the market reaction was, it was instructive.
Instructive is the perfect word. It wasn't some meme stock rocket ship, but it wasn't a sell-off either. The stock moved up, about 2.58% in the aftermarket?
Yes, settled right around $20.68.
So I'd characterize the mood as, moderately bullish.
Moderately bullish.
Yeah.
That feels like the market saying, okay, we see what you did there. Yeah. Now do it again.
That's exactly it. This was a total prove-it quarter. You have to remember, all through 2025, management's been telling this story about cleaning up the balance sheet. It's been a year of housekeeping.
A transition year is the phrase they kept using.
Right. And now, with this report, they're signaling that the cleanup is done, the trash is out, and actual growth is back on the menu for 2026.
So here's our game plan. We're going to hit the headline numbers first, the beat, the revenue, the buybacks. But then we need to spend some real time on the mechanics of their margin, which, frankly, defied the laws of physics this quarter.
It really did.
We'll talk about that strategic pivot from fixing to growing, and of course the acquisition of Blue Foundry. And then we'll wrap with not financial advice, where we pitch a trade that, let's just say, plays on the geography of this whole situation.
Sounds good. Let's get into the numbers.
All right, headline number first. Operating non-GAAP EPS came in at 55 cents.
And the street was at 49 cents.
So a solid beat, 6 cents clear.
That's a roughly 12% surprise to the upside. I mean, in this kind of mixed banking environment, a double-digit percentage beat is significant. It tells you their internal models are working, and they're executing better than analysts thought.
But, and there's always a but, the top line was a little softer. Revenue came in at about $336 million.
Just a hair under consensus. It was a miss, but effectively flat.
Does that worry you at all?
Not particularly, no, because if you just look at the miss, you miss the entire point. You have to listen to how the CEO, Curt Myers, framed this. He called 2025 a record year, with operating EPS of $2.16.
He's really trying to hammer home that point that despite the cleanup, the profitability engine is running hot.
Exactly. Revenue was flat largely because they were intentionally getting rid of assets, which I know we'll get to.
And they're backing that confidence with cash, a new $150 million share repurchase authorization.
Right, and they actually put some of that to work in Q4. Bought back about 1 million shares for just under $20 million.
Which signals confidence, sure. But honestly, the buyback is the side dish here, isn't it?
Oh, completely. The main course, the thing that actually matters for the long-term thesis, is the net interest margin, the NI.
Okay, let's unpack this. Because usually, this is the part of the cycle where regional banks start sweating. The Fed cuts rates, and the yield on loans drops faster than they can cut what they pay depositors. It squeezes the margin.
That's the textbook definition, yep. And between September and December 2025, the Fed cut rates by 75 basis points. By all logic, Fulton's margin should have compressed.
It should have been crushed.
But it didn't. It expanded. Their net interest margin climbed to 3.59% in Q4.
How? I mean, how do you expand margins when the rate environment is collapsing? Is it magic or is it accounting?
It's neither. It's what they call beta discipline.
Beta discipline. Sounds like something from a corporate retreat. Translate that for us.
Well, in banking, beta is just a measure of how much your deposit rates change when the Fed changes its rates. Fulton's cumulative interest-bearing deposit beta is just 30%.
So for every dollar the Fed cuts, they're only passing on about 30 cents of that change to their depositors.
In this context, it means they're managing to lower what they pay out very, very effectively. They drove their total cost of funds down by 13 basis points just from the last quarter.
Which implies their customers are sticky. They aren't just fleeing for a slightly better rate somewhere else.
That's the power of relationship banking. But there's a second piece to this. It's their asset sensitivity.
Right. They describe themselves as neutral to interest rates.
They say neutral, but the data is even better. They have about $5.7 billion of assets, mostly loans, that are repricing in the next 12 months.
So old loans rolling over.
It's a mix, but the key is the blended yield on that chunk of business is 5.01%. So even as market rates are dipping, this massive part of their book is holding the line on yield. It's a huge buffer.
So it's offsetting the drop in short-term rates. Very sturdy.
It's a very strong position. But we have to pivot to the future because 2025 sounded, well, exhausting.
It sounded like a construction zone. Management kept talking about these strategic actions that acted as an $800 million drag on growth.
$800 million. That's not a rounding error. That's a massive piece of the balance sheet.
No kidding. So what were they actually doing?
They were deliberately shedding risk. Think of it like pruning a tree. They were letting their indirect auto portfolio just run off.
So car loans arranged by the dealer, not the bank.
Exactly. Lower margin, not really relationship driven. And at the same time, they were aggressively resolving what they call adversely rated loans.
Which is polite banker speak for getting rid of bad loans before they blow up.
You got it. And so what here is crucial. If you just looked at the headline loan growth for 2025, it looked awful. But if you strip out the $800 million of intentional shrinkage, the core business was actually growing around 3.5%.
So the engine was working, they just had the parking brake on.
That's a great analogy. And the entire thesis for 2026 is that the parking brake is coming off.
Which brings us to the guidance. They're calling for mid-single-digit loan growth in 2026. Now, is this just CEO optimism, or is there something real behind it?
It seems to be backed by data. They said their commercial pipeline is up more than 10% year over year. That's a real leading indicator.
And they've been hiring, too. Adding bankers in commercial, business banking, the SBA division.
You don't hire expensive bankers if you don't have leads for them to call. It shows they're shifting from defense to offense.
Okay, let's get into the hard numbers for the 26 guide. Net interest income projected between $1.12 and $1.14 billion.
Which fits with that margin story we just talked about.
And non-interest income between $285 and $300 million. But here's the number that caught my eye. The provision for credit losses is only $55 to $75 million.
That seems remarkably calm, doesn't it?
It does. It implies a very stable credit outlook. They are not expecting a big spike in defaults.
Not at all. And look at their rate assumption. Their entire guide is built on one 25 basis point Fed cut in March. That's it.
That's very specific. They're not hedging.
It's conservative, but it's realistic. They have a base case, and they're building their budget around it.
Okay, let's shift gears to the big shiny object. The M&A deal. You're buying Blue Foundry Bancorp.
Correct. Expected to close in Q2 of 2026.
Whenever I hear regional bank acquisition, I immediately pull up a map. Where are they going?
Northern New Jersey. This is a pure footprint play. They're adding about $2.2 billion in assets and 20 financial centers.
Northern New Jersey. Okay. So are they trying to become a New York City bank? Are they chasing skyscrapers?
No. And this is a critical distinction they made on the call. They are staying in the New Jersey suburbs. They are explicitly not crossing the Hudson River into New York City.
It's the bridge and tunnel strategy, but they're stopping before the tunnel.
In a way, yes. It minimizes the risk of getting tangled up in the chaotic Manhattan commercial real estate market, which, let's be honest, is a dumpster fire right now.
So they get access to the wealth that lives in those suburbs without the exposure to empty office towers in Midtown.
Exactly. And the economics look good. They're targeting over 5% earnings accretion in the first full year. So you got the organic machine restarting, plus this acquisition bolted on top.
Sounds good on paper. But what about under the hood? I saw a comment about snow removal.
I did. It's one of those relatable details. Operating expenses in Q4 had some noise. They specifically cited unseasonably high snow removal costs.
I feel that in my soul. But does that actually move the needle for a multi-billion-dollar bank?
Well, that, combined with some high healthcare claims, created a blip. But the point they were making is, if you strip that noise out, expenses were basically in line. It's their way of saying, don't panic, we didn't lose control of the checkbook.
So nothing structural to worry about on costs. What about credit quality? Everyone is terrified of commercial real estate CRE.
The metrics at Fulton tell a totally different story. Non-performing assets actually improved. They dropped to 0.58%. Net charge-offs were super low, just 24 basis points.
24 basis points is basically nothing in this environment.
It is, and management said they aren't seeing cracks in their CRE book. Again, this goes back to their geography. They're financing medical offices in Pennsylvania, not 50-story towers in San Francisco.
Got it. Okay, let's zoom out. Synthesize this for me. Why does the market only seem moderately interested?
Because Fulton is trading like a bank that has just turned the corner. Their capital position is a fortress. The CET1 ratio is around 11.8%. That's plenty of firepower for buybacks and the acquisition.
But there's a disconnect, right? The CEO is saying record year, but the stock is only up about 16% over 3 months, and it's actually down slightly over the last year.
That's the divergence. Investors are in show-me mode. They like the story, they like the margin expansion, but they've been burned by regionals before. They want to see if the Blue Foundry integration actually works, and if that loan growth truly shows up in the numbers for Q1 and Q2.
It feels like the market is dating Fulton, but it's not ready to propose marriage yet.
That is a perfect assessment. They want to see a few more good dates.
All right, that covers the rational analysis. Now it's time to get irrational, or at least highly speculative.
My favorite part of the show.
It is time for our segment. This is not financial advice.
And let me just say, this is absolutely not financial advice. Do not do this with your rent money. We're just pitching ideas like we're in an investment committee meeting.
Okay, pitch me. What's the trade?
I call this trade the Jersey Turnpike toll booth.
The Jersey Turnpike toll booth. Okay, I'm listening.
Here's the setup. Fulton Financial is boring. It's a Pennsylvania bank. But they are acquiring Blue Foundry in northern New Jersey right at the exact moment they finished cleaning their loan book.
Okay, a clean bank entering a new wealthy market.
The trade is a pair trade. You go leverage long on Fulty using call options, hedged with a short on a generic Metro NYC office REIT ETF.
Whoa, so you're playing the geography gap. You are pitting the suburbs directly against the city.
Precisely. You're betting on the suburban flight continuing. You're betting that businesses and wealthy people keep moving to northern New Jersey, which benefits Fulton's new footprint. They capture the mortgages, the small business loans, everything.
And at the same time, you're betting that the office towers in Manhattan continue to suffer from high vacancy and refinancing risk.
Exactly. If the city struggles, your short prints money. If the suburbs boom, your Fulton calls print money.
But why the leverage on the long side? Why the calls?
Because of the potential for multiple expansion. Right now, Fulton is priced like a sleepy value trap, but they just proved their net interest margin is durable at 3.59%. If they hit that mid-single-digit loan growth plus the 5% accretion from the Blue Foundry deal...
The market has to reprice them as a growth stock.
Exactly. You ride that multiple expansion from boring value stock to regional growth story. You're basically setting up a toll booth on the exit ramp from NYC to Jersey, and Fulton is collecting all the tolls.
The Jersey Turnpike toll booth. It is reckless, it's specific, and it relies on a sociological shift as much as a financial one. I love it.
It makes just enough sense to be dangerous.
Again, folks, that is for entertainment purposes only. Please do your own homework.
And watch those snow removal costs.
Seriously. So let's wrap this up. Final takeaway.
Strong beat. Margins defied gravity. The balance sheet is clean. 2026 is set up to be the year they prove they can actually grow again.
The question for you, the listener, is simple. Do you believe that mid-single-digit loan growth story? Is that pipeline for real? Or do you think macro headwinds are going to blow that house down?
It's all about execution now. The cleanup is done. Time to build.
That's it for this deep dive on Talk Tickers. We'll catch you on the next earnings call.
Stay curious.